When should you take less risk for retirement? Chances are you've checked your 401k balance lately, and it's caused a little bit of concern with the recent volatility. We've had big ups, we've had big downs, and we've come back. But inside of it, what it made us realize is that the stock market giveth and the stock market taketh inside of it. And so when should we have less volatility or less risk inside of retirement? Hi, I'm Devin Choles, founder and CEO of Choles Financial. And on this week's Key to Yes, we're going to go over volatility inside of retirement. Now, when it comes to your money inside of retirement, there's a few things that we want to go over. And the first one up here is why reducing risk matters. There's a few pieces that come to this. One of the largest ones is the sequence of return risks. If you were lucky enough to retire in about 2010, 11 or so, and then go on the longest running bull market in the history of the stock market, chances are you actually have more money in your account today than what you started with, and you've taken out all those distributions to live on over that time frame. But on the other side, if you weren't so lucky and you decided to retire at an all-time market high in, let's say, 2007, and the day you retired, the market went down another 50%, and it took you years and years and years to get the money back, and you may not even have it all back, and in fact, it may have actually impacted your ability to stay retired. Sequence of return risk matters. Now, when you're in the accumulation phase of life, when you're putting money in, all those ebbs and flows in the market, they don't really matter, right? Because we're not using the money. But the day we retire and we draw that line on the sand, the sequence in which those returns happen, if we have a lot of losses up front in our retirement, we're going to have a very hard time not outliving our money. But if we're lucky enough to retire into a great running market, we could be okay. But either way, the big piece is building an investment plan that supports our income regardless of what type of market it is. And that comes from having a written retirement income plan that is supported by a great investment strategy. Now, the next piece on here is how to assess your current risk exposure. Now, a lot of people, they went to their job, they went and set what's in their 401k, how it's allocated, how it's been growing when they were in their 30s or 40s. Chances are now you're many years down the road, 10, 20, 30 years, I guarantee you that your risk tolerance, your risk capacity is completely different because you're in a different stage of life. You're going from the accumulation phase to that distribution phase, and we're going to draw that line on the sand. So we have to start paying attention and making sure that we're allocated correctly based on your stage of life alone. Now, I get this a lot as well. The second piece that is really concerning is a lot of people think because it's in my 401k, it's safer, or because I know the name of the company, it's safer, or because I've worked for XYZ for so long, my money's okay. Now, that last one that I just talked about, you may have worked for the company for 30, 40 years. Your money isn't at the company. That 401k company, let's say it's Fidelity, T. Rowe Price, your money isn't with them. It's where the assets are actually held and invested in. That's what makes the difference. Okay? So inside of that, we want to make sure that we don't conflate the aspect of that just because it's somewhere we know and we feel like that it's trustworthy, that our money is safe and is going to make us successful through retirement. Creating a balanced portfolio is very important. When it comes to retirement, we're no longer focusing on just growing our money. We're focusing on distributing that money and making sure that that money lasts longer than we do. And so that's where we come in, and we have to shift how we're invested. And with that, using things like bonds, dividends, annuities, REITs, things of that nature will allow us to stretch those dollars by shifting just from how fast can we grow it to how long can we preserve it. All right, folks, this is Devin Choles on the Key to Yes. Thank you so much for coming out. That's all we have this week. Let's go ahead and like, subscribe, and follow, and we'll see you next week. Thank you.